Hey there, it's Mitch Goldberg, the host of Be the Boss of Your Money. Welcome to my live stream. This is all about personal finance, investing, sharing knowledge with you so you could make the best possible financial decisions for you, for your family. That's all this is. It's about sharing information. And we're going to talk about interest rates, the Fed, what's really going on with the stock market. And it affects everything from rates that you pay for leases, car leases, auto loans. I mean, you name it, mortgages. It's all about the interest rates. And we want to make sure that you understand what's going on, especially with the stock market, because if you're watching this, you probably have money in the market if you're watching this. So we need to talk about this. I'm going to roll the quick intro. We're going to talk about how investors just don't believe that the Federal Reserve has such strong resolve to get inflation down to what it thinks is an acceptable level. And as a result, investors are probably playing with fire and they could get burned. I mean, I think investors have already gotten burned, but I still think hope springs eternal. When does a bear market end? Not when hope springs eternal. When hope just dies. That's when bear markets end. Let's roll the quick intro. Let me put up the banner intro and stick around. It's going to be good. It's going to be fast. If you have any questions, please ask me in the comments. I love hearing from you. And while you're watching, please give us a thumbs up, a heart, an applause reaction, depending on which social media platform you're watching from. Help spread the good word about the work we're doing here. And here we go. All right, we are back. Thank you so much for joining me. My name is Mitch. You're just, if you're tuning in now, we're just getting started. And if you're watching in replay, thank you very much for joining me. If you have any questions, hit me up in the comments. I love hearing from you. Just say hi, share with me your favorite emoji. You know, when I get comments, it helps with engagement and the algorithms on all the social media platforms. So it's really good. And of course, when you do that, you leave a thumbs up, I get to see who's watching and it gives me a gauge of who to tailor my content for. So if you want some tailored content, if you want tailored content, all you have to do is like it, and I'll see who's out there. Your questions are always appreciated. I love hearing from you. It's the best part about this. So the story is this: hope springs eternal. Investors are basically saying to the Fed, I'm, of course, paraphrasing what billions of people are thinking at the same time. General feeling is this: investors are going to wait out the Fed. They're going to wait it out. They're sitting on a lot of cash. Early investors have already blown out of a lot of stocks. This is why you see stocks like Meta, the old Facebook name, right? Okay. Netflix, Alphabet, certainly Tesla, even Apple. These stocks have tanked. So it's not just about the pandemic stocks like a Roku or a Carvana or a Peloton. Those stocks have gotten crushed, and I personally have serious doubts about whether or not those stocks could ever recover to their old highs. It was just a very strange situation with what the pandemic did and how people thought of the future. And what people thought of the future turned out to be very temporary. We're not just staying home and watching movies on our TV all the time. We go out, we have lives, we do things. Okay. So the Federal Reserve's target for inflation is roughly 2% rate. At that rate, the Federal Reserve, from now on, I will just say the Fed thinks 2% inflation rate is a healthy rate. Prices are growing a little bit. Economic activity is humming along, not too hot, not too cold, but just right. We call that a Goldilocks economy. And everything is pretty much steady. It's hands off. Now inflation has spiked. I don't want to say inflation is out of control, though some of you will agree with me, and I could maybe now get some hateful comments or disagreeable comments that I said inflation is not out of control. Well, it is coming down. It's coming down a lot. It was at 9% plus on the CPI at one point, Consumer Price Index. Now it's in the fours. And I could see it going down a lot more. All right. Now, when I say inflation is moderating, I don't mean that the prices we were paying for things in 2019 that we were paying in 2019 are going to go back to those prices. Prices have gone up a lot. It's just when we talk about inflation, we're talking about from where we are now to how fast prices are rising. That's what I mean. So inflation moderates to get back to a 2% pace. It doesn't mean prices go back down to where they were a couple of years ago. If they could just stay where they are, that means 0% inflation. So when we talk about inflation moderating, some people think that means prices are going to go back down to where they were. And some people think that means prices are going to stay where they are. They'll just stop going up. In the world of economics, of Wall Street, of investing, it's the latter that we refer to. Okay. And believe me, I have a car lease that that is about to come up. And you can imagine the sticker shock I'm having when I see what it costs to lease the very same car now. It's hundreds of dollars more per month, to the point where I'm not even going to lease the car. I'm just going to buy a car and hold on to it. Fine. There's a lot of good cars on the road, so I'm kind of excited about it. In any event, I'm totally digressing. The Fed has said that they don't think investors believe in its resolve to tamp down inflation. Investors think, we'll wait it out. We know the Fed's going to blink. They'll probably see the economy slow down, a little bit more, unemployment go up a little bit, and then they'll blink and they'll stop raising rates, which is the pause, and then they'll start cutting rates, which is the pivot. We keep talking about pause and pivot. No other time in my career have I seen the words pause and pivot used for when the Fed stops raising rates and then cuts rates, but I do like the terms. I think they are actually pretty good terms to use, pause and pivot now. So they're part of our permanent economic vernacular. So I want to try to put this context. So the Fed has come out and said that. And the Fed said that today. They released their minutes. They take minutes when the Fed meets. They have their minutes like any other group when they raise rates in their December meeting. And the minutes said, I'm paraphrasing, investors don't really believe our resolve to get inflation down, to get the rate of inflation down, and therefore we have to keep going. And someone's got to blink first. Investors don't believe the Fed's going to go as high as the Fed could possibly go. Investors are thinking the Fed's going to blink. And the Fed doesn't want to blink. They want investors to blink first. So who's going to lose this battle? Because there has to be a winner and a loser. Maybe that's not the best way to put it. I don't think Fed Chair Jerome Powell is thinking in terms of that. But he has said he's not blinking. He wants to, and they said in the minutes, not only are they going to continue to raise rates, not only does the Fed not see a rate decrease in this year, 2023, they see rates going higher. They see themselves raising rates and staying higher for longer until inflation is firmly battened down. And I don't think investors believe it. And I think if I had to pick a winner and a loser, I'm going to bet on the Fed and I'm going to short the investors. I don't think investors win here. I go long Fed, short investors. By the way, to my compliance people, we're going to monitor this. I'm not suggesting shorting stocks. I'm just saying it's a term, believe in the Fed that will win, not the investors. Not saying shorting stocks. Okay. Thank you, Rita. I know what you're thinking. All right. So there you go. But that's the big story of the day. And every time we have an employment report a GDP report, whatever we have coming out, investors think, oh, wow, let's look at this next major economic statistic coming out and look for that one to give us a clue if the economy is getting weaker. Because if it is, the Fed's just going to pause and everybody's happy and we go back to the races and all these stocks will go back up. If you think it's so easy for that to happen, you're I want to say this gently. You may be a little misguided. You may be a little naive on that. It doesn't work that way. Bear markets end when you give up hope, not when hope springs eternal. Bear markets end when you finally throw in the towel and say, this is awful. I never want to have anything to do with the stock market again. And then we start a new bull market. We have not had a washout. When people still think you could just run out there and buy the big winners of the last few years in tech, you know who they are. I'm talking about the Amazons, the Facebooks, and just analysts and investors alike come out and say, you got to buy these stocks because they're going to take off now. It takes years for these things to happen. Remember Boeing? Boeing was a $400 stock. The MaxJet problems hit. Then they had to withdraw the MaxJet from the market. Stock went from 400 down to like the 80s. And that was what, 5 years ago? And now it's not even back to 200 yet. And that was never anywhere near the valuation that some of these large cap tech stocks had. So it takes a very long time for these things to recover. The damage has been so extensive in the technicals of these stocks and in the psyche of these stocks. So when people finally start to think that averaging down in these big stocks we talk about all the time, when they do that, that is when I think you get the green light to buy them. But right now, there's too much hope, and that is what I think. So take it from me, someone who's been in the industry for over 30 years. There are plenty of sectors and stocks to look at, including those. So I'm not making a recommendation here. Let's say you should short this or sell it or buy this or buy that. I'm giving you my own personal experience, my own personal, my life. I've been doing this for over 30 years. That the winners of the last bull market do not just reappear and become the winners of the next bull market. I remember in the 1990s, drug stocks were hot. They were so good. Consumer staple stocks were so good. And in the 2000s, they did nothing. It took 15 years for the NASDAQ to recover its 2000 high. Imagine right now if it took 15 years for the S&P 500 or NASDAQ or Dow to get back to their former highs. And in 15 years, we don't even know what stocks are going to be viable. I mean, IBM is still a stock, but I mean, I don't know anyone who's made money in IBM in the last 15 years. So same with Cisco and Intel. So don't just automatically assume. Think for yourself. And that's what I'm trying to say. If averaging down in some of these mega tech stocks is something you think is a good idea for you, that's up to you. That's a personal finance decision. But I wouldn't make that your only strategy, that's for sure. There's plenty of things to do. Remember the 3D printing stocks? Did they ever recover? Pot stocks? Did they ever recover? SPACs got killed. Like stocks that are related to crypto. What about the meme stocks? Dead. I just think people have this expectation that what they're familiar with will recover very quickly. And I just don't think it works like that. Now, the common wisdom on Wall Street is that the stock market will test a new bottom, its October lows, sometime between now and the middle of 2023. Okay. I keep saying 2023 because I have to get used to saying it. I'm still saying 2022. I'm still writing 2022 on things. But I think a lot of us are doing that. So if the market's going to bottom out, we'll just wait. We'll wait it out. We'll sit in some cash. We'll hold on to some stocks. But we like what we have. We'll ride it out. that just speaks to a lot of confidence of a strategy that we have no idea if it's going to work or not because we've never been here before. Since the Fed started letting bonds roll off its balance sheet, quantitative tightening, the Fed's balance sheet has actually uh, retired about $365 billion worth of Treasury securities in the last couple of months. And it's going to continue. It's still like an $8.6 trillion balance sheet. But I don't think it's going to be so easy like the way people think. I think there's still so much confidence. And I know things come back. Well, let me tell you, I know things come back, but let me tell you this. Markets recover. Diversified investments recover. But stocks don't always recover. Individual stocks could go down and stay down and never recover and disappear. Now, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And this market certainly has proven that to us big time. All right, so that's what's going on. Let's take a look at the bond market because I think this is like telling us something that a lot of people don't want to hear. So let me just pop myself in here. I'll get rid of the social media icons. Okay. U.S. House adjourns until 8 p.m. tonight without a speaker after GOP. I guess he lost another vote. I've been keeping track of this all day. He's just, losing vote after vote, but it's very interesting to watch. Why is going from 4 months out to 30 years, why have interest rates been dropping in the Treasury curve? Everything's been dropping lately. In spite of, you keep hearing the Fed's going to raise rates and inflation is going up. I'll tell you why, and this is really, really important. This is like the most important data sheet right here. These negative numbers on the Treasuries, okay? I'll tell you why. It tells you that investors continue to see inflation moderating. Inflation is moderating. What's moderating? Well, the price of used cars is plunging. This is why companies like Carvana are believed to have a strong possibility of going bankrupt. CarMax, same thing. That's what it's telling you. The cost of new homes, it's not that they're going down, but builders basically stopped building. Rents are going down now. Lots of prices are going down. And inflation is starting to moderate. And that's showing up in the CPI number. Also, inflation's been moderating. It's not going to moderate down in a nice, gentle glide. It could still fluctuate. But that's what's happening because the economy is weakening. It's not weakening enough for the Fed to say, let's stop raising rates or let's raise rates. Remember, if the Fed gets to the point where they decide to cut rates, the Fed is usually late to doing things, not early. We will really be in a bad situation for the economy. Okay, let's not use hyperbole. It could be a mild recession, could be a medium recession. It could just be economic, a moribund economy. So we have to see. All right, who is out there? Scott. Happy New Year, Mitch. I thoroughly enjoy watching your show. Hey, Scott, thank you so much, man. I am very touched. Thank you. And you are one of the smarter guys out there and successful. And thank you so much. I greatly appreciate that. Scott and I know each other from college, fraternity brothers in the 80s, 85 to 89, SUNY Albany. And that is awesome. What I love about going to a SUNY school is that as an adult, all my friends still live in the area, and certainly Facebook helps as well. Thank you very much, Scott. I am touched that you take the time to watch. It means a lot. All right, so that is pretty much it. Do we want to talk about the stock market today? I think the stock market's like not as relevant as the bond market right now, but Dow was up a little bit. Just pop myself up. NASDAQ was up a little bit. S&P was up a little bit. Oil is continuing to just absolutely plunge because of demand worries. And we'll see what happens. I think the setup is still going to be tough for investors. Now, let's just end the show by saying this. If you're investing with a 10-year or longer time horizon, don't worry about the stuff. If you're getting to a point where you're going to start to worry about needing some of your money for retirement, for other big expenses, financial commitments, that's when you really need to start thinking in terms of how much you'd be taking out of the market and putting that money into something more stable. In any event, I so greatly appreciate all of you watching. I'm going to let you go, and I will be back tomorrow with hopefully a boring show because it'll be a boring day. Have a great day.